Ladies and gentlemen, good morning, and we are about to have the big event, the elections in the States. What has the market done to prepare itself for this event? Well, this is a chart of the 10-year note, the ETF, which represents the 10-year note, which is IEF. And as always, when the market is uncertain about a big event, it takes itself somewhere near to the 200-day moving average. So the market rallied slightly last week. This is the 200-day moving average, which comes in around 111, and the market rallied in a risk-off manner towards the 111 moving 200-day moving average to better be able to respond to any surprises. Now, the odds of a Clinton victory with all the bookmakers, just like during Brexit, are hugely in favor of Clinton winning, and therefore the market will not go through the 200-day moving average, but try to get to as close to as possible to it to be able to respond on both the upside and the downside. Since the odds are still favoring very much a Clinton victory, we would expect this to resolve to the downside after the election. The same has happened basically in the ES, where we have a tag of the 200-day moving average just before the election, with every single day the past week being a down week. What would be our expectations now? Well, if Clinton wins, the battleground is going to be in this area. The battleground is basically going to be between 2110 and 2140. The market should definitely rally on the back of a Clinton victory because for several reasons. One is that volatility will start coming off, and therefore people to have to unhedge their positions, and all the people who sold over the past couple of weeks fearing a Trump victory will no longer have that reason, and therefore they will start buying their shorts back or their positions back, and the battleground becomes the 2110, 2140 area. How the market reacts there is going to be pivotal. There are two schools of thought here. We subscribe now to the school of thought that says the market has come off only partly because of the uncertainty of the election, but mostly because of fundamental downgrades in the macro scene, together with the expectations of an interest rate hike in December. Therefore, we feel that the upside, which we think we will see, will be limited to the 2110, 2140 area, and that the resolution will come only 3 or 4 days after the election, when the next part of the trend can start unfolding. So what we're saying, if the market cannot hold the 2110, 2140 area, and any spikes are confined to 2140, 2145, which were so hard to bust on the downside, we will have a setup for a further leg down. In case of a Trump victory, it is very hard not to see the market trading down towards 2000, even down towards the 90-50 area in the short term. The dollar has done exactly the same. This is a daily chart of the euro. The dollar has now come back as close as possible to the 200-day moving average. We would expect a downdraft to test these lows again on a Clinton victory, and certainly a move towards 115 in case of a Trump victory. We think that the dollar is going to respond most to a Trump victory and his protectionism, and that the devaluation of the dollar is going to be very pronounced in case of a Trump victory. It'll be a complete change of policy. Don't forget that the dollar is not controlled by the Federal Reserve. The dollar is controlled by the Commerce Department and therefore political appointees, and the dollar could get absolutely destroyed on a Trump victory. In fact, your first trade on a Trump victory is to be short of dollars. Everything else can wait. Being short of dollars cannot. What do we expect for volatility? Again, in case of a Clinton victory, which is now almost assured by the latest polls that have come out over the weekend, we expect the volatility index to come back towards the 15 and 3/4, 16 and 1/4 area. That would equate to about a 20 to 25% drop in the VXX, down towards the 31, 32, 33 area. We just cannot see volatility remaining extended over the course of the first 3 days of next week, simply because whatever happens, the market reprices and then volatility falls. It happened in the case of Brexit. It happened in the case of the falls back in August of last year. Volatility at this level is just unsustainable, because we don't have, unless Trump wins, that is very much the the fly in the ointment. If Trump wins, we can see spikes of volatility to 40% without any problem. But if Clinton wins, we will definitely have a fallback in volatility towards the 15-16 area over the next 3 or 4 days. And that is why we're saying that the first move, the first reaction in the ES should definitely be to the upside and go to the battleground area around between 2110, 2120 and 2140. This volatility fall can be best be seen in this volatility ratio, which is now hugely oversold. We expect, as the market retraces towards the middle Bollinger Band, 2130, possibly test these levels around 2150, to have this ratio go back to overbought. And that would only happen if volatility fell very markedly. As we said, we expect volatility to fall by a good 20 to 25%, and then make a move possibly higher if we continue the move down on the fundamental reasons for a market fall. But the first move we definitely see as up in the market, up in this ratio, down in volatility, down in the dollar, and especially down in gold. The market has bid up gold as a risk-off alternative to equities. However, the gold price has only managed to return to 0.618 retracement of this move down, not even 50% of this whole move. So we expect the next big move in gold to be down on a Clinton victory. So a Clinton victory is good for the dollar, it's bad for gold, it's good for equities, and it's marginally bad for fixed income. The reverse is also true for a Trump victory. For a Trump victory, the dollar is going to be the trade of choice, i.e. short dollars against everything, especially yen and especially Swissy. Gold would probably soar to at least the 1350 area on a Trump victory, and the market that will get hit most would be probably the 10-year note. We think that with his ideas about building walls and huge infrastructure projects and so on, as people abandon the dollar, they will also abandon American bonds. So we would not be surprised, excuse me, to see a big move in the 10-year note to possibly all the way in the IF, all the way down to around the 108 area and test this trend line support, which is very long term. This would be way over probably 2% in the 10-year note. So even though the dollar is should be supported by higher interest rates, it won't be. It will be just a sentiment trade. The yen will go probably below 100 very, very quickly. And let's put a chart of that. It would probably test this line very quickly and then continue falling out of this wedge pattern, possibly all the way down to 90 in double quick time. We don't think it's going to take very long for the yen to be absolutely destroyed. I mean, the dollar yen to be destroyed, simply because the Trump policy is going to be to devalue the currency to make sure that jobs remain in the country, and that will be expressed mostly in the yen and its value, which is tied somehow to the renminbi. We expect carnage in the yen. Fundamentally, we are at a very important juncture. Look how the market has come right on top of the times 16 Blue Angel. It could now bounce violently towards the 2140 area, and then quite possibly, if it cannot sustain those levels, come all the way back down to 2000 or slightly below to the times 15 Blue Angel. Why do we think that is a possibility? Because if we look at the breakdown of the sectors, we see continuous downgrades in consumer discretionary. Look how this line is now falling over and expectations for earnings are falling. This market could come off another 10% without any problems and test the levels way below Brexit. We could have test the levels where it was last February without any problem at all. Consumer staples, if the bond market gets hit on a Trump victory or even a Clinton victory, because we think the bond market goes down regardless, have a long way to fall. The energy sector also has a long way to fall. The only sector that we feel is very well supported is financials, and that actually reinforces our view that the yield curve steepens whatever happens. In case of a Trump victory, it steepens a lot more than in the case of a Clinton victory, but in both cases we think longer term the yield curve steepens. Healthcare we can no longer be bearish of, simply because it is now oversold, but healthcare at best will hold in and trade in a 5% range. While this is the one that really worries us, industrials. We are now at the same level that we were back in 2014 in expected earnings. And look where the market was trading in 2014. It was trading down at this spike down, which happened in February of this year. So this industrial index could go all the way back down to the 1800s in S&P terms without any difficulty whatsoever. XLK, we are also not bearish of, simply because the earnings picture looks brighter and brighter overall, but even this in sympathy could give up 4 or 5% without any difficulty. The materials are not looking that great. Telecommunications we're not bearish of, we quite like, but even they could quite easily come back to where they were in February of this year. And finally, utilities we think are going to get hit whatever happens and come back to where they were at the beginning of the year. So there is a definite possibility when you put all these sectors together to revisit at the very least the 15 times Blue Angel after a period of short-lived euphoria where the market bounces off the times 15 for a week or 2 weeks or 3 weeks, and maybe at the beginning of next year, once the positive flows are over, we could come all the way back down to the 15 times Blue Angel, which at the moment is somewhere around the 1950 area. So definitely a more bearish slant than we've had for the past, call it 6 weeks, because we see the deterioration in earnings in key sectors of the S&P. Our biases for next week, well, the Bund BTP unfortunately has gone, but we'll keep it there just in case that it ever comes back. We doubt it. Should have held that trade. ES, as we said, value longs around here with a tightish stop of 1%, and we still want to short it back up over around 2140. TLT and IEF, we think that any brief rally on the back of a resolution to the election question, a positive resolution, will be sold very, very quickly. We want to be sellers of bonds in whatever happens after the election in case we get a nice little spike. The dollar will be weak on Trump, as we said, and that's your first trade, is to sell dollars on a Trump victory. Level almost immaterial. Currencies preferred yen and Swissy. And there will be continuation on strength on Clinton, insofar as, just like in ES, people will take off their short dollar positions or re-establish long dollar positions, which should definitely push the market lower for a few days. The stocks in the Nikkei would benefit from a Clinton victory and would possibly be better longs than ES for the short term. Gold expected to come off about 3 to 4%, i.e. $30–40 on a Clinton election. So from 1310, call it 1270, 1260. That would not surprise us in the slightest. And the true beneficiaries long term of a Clinton victory, we feel, will be emerging markets. The emerging markets longs against S&P shorts are probably one of the better trades out there that we think will happen for the long term. We're really talking about 1–2 years out now, as opposed to 1 or 2 weeks out. So we would, in the long-term portfolios, be looking to switch out of all American non-tech or non-interest rate sensitive ETFs, like the financial ETF. So those we want to keep. We want to keep financial and we want to keep technology, and switch all the other holdings that we have into some sort of emerging market holding. Those are our strategies for next week. Remember, we as traders, all we can do is we can play the highest odds market. The highest odds market, given the what we know about the US election is that Clinton will win, and that therefore volatility will be smashed back by about 20%. The gold trade, which has been to a risk off, will be smashed 3 or 4%. So our positioning going into the elections has to be one of short volatility, slightly long of ES, short of gold, and slightly long of the dollar. That, of course, would very rapidly be reversed, and we definitely also want to be short of 10-year notes and 30-year notes on a spike up. So if we have a trade up towards this 110 area, 111 area in IEF, we definitely would want to be short of it around 111, looking for new lows. Those are our biases. We are almost 99% certain that Clinton will be elected, and that the first market response will be to rally, and we will be looking forward to taking profits into those rallies and possibly establishing shorts, looking for the market to give up all the gains that it made post-election and go down even more once people realize that earnings are beginning to deteriorate, and the prospects for a Clinton presidency are not very bright at all. Thank you very much indeed. Good luck to you, and of course we'll be with you every step of the way next week.